Ladies and gentlemen, what I'm about to lay out for you is not a market rumor, not speculation, and not theory. This is a documented sequence of events that unfolded in real time. Today is Wednesday, January 15th, 2026. 48 hours ago, on Monday, January 13th at 11 a.m. Eastern Time, Elon Musk personally authorized the largest single silver procurement operation in Tesla's history, 85 million ounces of physical silver. That number is not a typo. It is not rounded. It is not exaggerated for effect. 85 million ounces of real deliverable silver were secured through a coordinated strategy involving spot market purchases, forward contracts with miners, and direct acquisitions of vaulted metal. And this decision did not happen in a vacuum. At the exact same time, Tesla was locking up supply. Samsung Electronics was attempting to secure the same metal. Samsung bid aggressively. They negotiated, they offered escalating premiums, and they lost. Tesla outbid them and walked away with the silver. Samsung did not. As a result, Samsung is now facing a severe production crisis that could delay its flagship solid-state battery rollout by 12 to 18 months. This is no longer a story about silver prices on a screen. Yesterday, January 14th, 2026, silver hit an all-time nominal high of $92.25 per ounce. While financial media debated whether silver was overbought, and while retail investors watched their portfolios fluctuate, a far more important battle was unfolding behind closed doors. This was a war for physical metal. Two technology giants were competing for the same finite supply of silver because both understand the same uncomfortable truth. The silver required to power the next generation of electric vehicles, grid-scale battery storage, and green energy infrastructure does not exist in sufficient deliverable form. Vaults are being drained. Miners cannot increase output fast enough, and the companies that secure metal today will determine who leads tomorrow's industrial economy. Those that fail to secure supply will fall behind. To understand why this matters, we need to walk step by step through what actually happened and why it fundamentally redraws the future of the EV and energy storage industries. On January 13th, 2026, at 9:30 a.m. local time, Samsung's global supply chain director convened an emergency executive video conference. The internal agenda item was blandly titled Critical Material Acquisition Status Update. In reality, the meeting was driven by panic. For the past 18 months, Samsung has been developing what it considers the most important battery breakthrough since lithium-ion technology was commercialized. Their solid-state battery design uses a silver-carbon composite layer in the anode. This layer suppresses dendrite formation, the microscopic crystalline structures that grow during charging and can puncture the electrolyte, leading to catastrophic failure or fires. By incorporating silver into the anode architecture, Samsung solved one of the biggest technical barriers to solid-state batteries. Their prototypes demonstrated a 600-mile driving range, charging times under 10 minutes, and more than 1,500 cycles with minimal degradation. It is a genuine technological leap. But it comes with a hidden cost. Each battery cell in Samsung's design contains approximately 5 grams of silver. A typical 100 kilowatt-hour EV battery pack uses roughly 200 cells. That means 1,000 grams of silver per vehicle, 1 kilogram, 32 troy ounces of silver in every car. Compare that to today's conventional electric vehicles, which use roughly 25 to 50 grams of silver, primarily in electrical contacts, circuit boards, and power electronics. Samsung's solid-state design requires roughly 40 times more silver per vehicle. And Samsung is not planning to produce a niche luxury product. Their internal projections target mass production. By 2028, they expect to produce 2 million solid-state equipped vehicles annually. 2 million vehicles multiplied by 32 ounces each equals 64 million ounces of silver per year, just for automotive production. When you add battery storage systems, consumer electronics, appliances, and industrial applications, Samsung's projected annual silver consumption exceeds 85 million ounces. Samsung knew these numbers. What they miscalculated was the assumption that silver would be available when they needed it. In December 2025, Samsung's procurement team approached the world's largest silver futures exchange and requested physical delivery of 20 million ounces for the first quarter of 2026. The response was blunt. Only 3.2 million ounces could be offered, 16% of the request. Samsung then turned to the bullion market. They contacted major dealers across North America and Europe. Combined, those dealers could commit less than 5 million ounces, with delivery timelines stretching 12 to 18 weeks and premiums ranging from $18 to $32 over spot. No price guarantees, no certainty. Next, Samsung approached the miners directly. They contacted every major silver producer across Mexico, Peru, and Canada. The response was even worse. 92% of 2026 mine production had already been allocated under multi-year contracts signed years earlier. The total uncontracted silver available globally for immediate purchase amounted to roughly 11 million ounces. Samsung needed 20 million ounces for Q1 alone. By their own internal calculations, Samsung was facing a shortfall of 12 million ounces in the first quarter, with the gap compounding every quarter thereafter. By the end of 2026, the deficit would exceed 50 million ounces. Without silver, they cannot manufacture solid-state batteries. Without batteries, they cannot deliver vehicles. Without vehicles, they cannot fulfill contracts already signed with automakers. So Samsung did what any desperate corporation does. They raised bids. Premiums climbed from $35 to $40, then to nearly $50 over spot for guaranteed delivery. That is when Tesla entered the picture. At 11 a.m. Eastern Time on January 13th, Elon Musk reviewed Tesla's internal projections for silver demand and made a decisive call. He authorized Tesla AS procurement team to secure 85 million ounces of physical silver by any means necessary. Price was irrelevant. Availability was everything. To understand why Tesla acted with such urgency, you need to understand what Tesla actually is today. Tesla is no longer simply an automaker. That narrative is outdated. Tesla operates three major businesses under one corporate structure. First, automotive manufacturing. Tesla produced 1.8 million vehicles in 2024 and is targeting 2.2 million in 2026. Each vehicle contains between 30 and 50 grams of silver in batteries, electronics, charging systems, and power management. That equates to roughly 8 to 9 million ounces of silver per year. Second, energy generation and storage. This is the segment Wall Street continues to underestimate. Tesla's Megapack and Powerwall deployments surged 60% year over year. The energy division's growth now rivals, and in some quarters exceeds, automotive revenue growth. A single Megapack contains roughly 200,000 battery cells. The silver used in interconnects, power electronics, and thermal systems totals approximately 12 kilograms per unit, or about 385 troy ounces. Tesla plans to produce 8,000 Megapacks in 2026, consuming over 3 million ounces of silver. Add Powerwall production, and total energy storage demand exceeds 4.5 million ounces annually. Third, and most critically, Tesla is rolling out 4 new battery cell designs beginning in 2026. These next-generation chemistries incorporate higher silicon content, which requires additional silver to manage thermal and structural stresses. Industry estimates suggest silver content per cell increases by 15 to 25%. When automotive, energy storage, and new battery designs are combined, Tesla's projected silver demand for 2026 alone ranges between 18 and 22 million ounces. But Elon Musk did not secure 22 million ounces. He secured 85 million. Why? Because Tesla learned the lesson Samsung is learning now. Strategic materials are not bought at the last minute, they are stockpiled. When supply becomes constrained, control of physical resources becomes a competitive weapon. Tesla secured its silver through 4 channels. First, direct mine contracts. Tesla signed forward delivery agreements with 6 major silver producers, providing upfront capital in exchange for guaranteed physical delivery over 24 months. These deals secured 32 million ounces. Second, vaulted metal acquisitions. Tesla negotiated directly with institutional holders who owned allocated silver stored in London and Zurich vaults. Facing margin pressure elsewhere, these institutions sold at a premium. 18 million ounces changed hands. Third, exchange-related accumulation. Tesla quietly acquired metal through intermediaries by purchasing expired warrants and sourcing silver from smaller holders exiting positions. 12 million ounces were secured without triggering a visible delivery squeeze. Fourth, off-market transactions. Tesla negotiated with Asian electronics manufacturers that had accumulated silver reserves during the 2022-2023 period. Facing cash flow challenges, they agreed to sell portions of their stockpiles through structured swaps and deferred delivery agreements. 23 million ounces were obtained this way. 32 plus 18 plus 12 plus 23 equals 85 million ounces. Multiple independent sources have confirmed these transactions. And here's the final twist. Samsung was bidding against Tesla for many of the same sources of metal. They lost. This is why the silver market is no longer about price discovery. It is about availability. It is about who controls supply. And it is why higher prices are not speculation. They are a mathematical outcome of industrial reality. What you are witnessing is not a bubble. It is a resource war. They were negotiating with the same miners. They were speaking to the same vault holders. They were circling the same limited pools of physical metal. And in every single case, Tesla's bid was higher. Not marginally higher, not 5% higher. Tesla was offering premiums of $50 to $70 per ounce over the COMEX spot price for immediate guaranteed delivery. With COMEX trading near $90 an ounce, Tesla was effectively paying between $140 and $160 per ounce for real metal delivered and allocated. Samsung could not match that. Samsung's executive committee had authorized premiums up to $48 over spot, but when it became clear that Tesla was willing to go far beyond that, Samsung realized they were playing an entirely different game. Tesla has roughly $40 billion in cash on its balance sheet. Samsung has liquidity as well, but Samsung is simultaneously funding semiconductor fabs, display manufacturing plants, consumer electronics lines, and next-generation foundry expansions. They could not commit tens of billions of dollars to a single commodity without full board approval. And board approval takes time. Tesla did not wait. Tesla moved faster. Tesla paid more. Tesla took the metal. And what Tesla just did has consequences that extend far beyond one corporate rivalry. This was not a one-time purchase. It was a signal. It was a declaration that the most sophisticated companies on Earth have concluded that silver is no longer available at any reasonable price through normal market channels. Once that realization spreads, once Apple, Google, BYD, LG, Panasonic, and every other major technology and automotive player understands that they are all competing for a finite resource that simply does not exist in sufficient quantities, the bidding war does not move linearly. It goes vertical. To understand why, you need to look at the actual supply and demand math of the silver market. Global silver mine production in 2025 was approximately 780 million ounces. That is the total amount of silver extracted worldwide in an entire year. Of that production, roughly 70%, about 546 million ounces, comes as a byproduct of mining for other metals such as copper, zinc, lead, and gold. In these operations, silver is not the primary target. It is recovered incidentally. That distinction matters because it means silver supply is structurally inelastic. Even if silver prices double or triple, it does not automatically lead to higher production because the economics of those mines are driven by base metals, not silver. Only about 30% of global production, roughly 234 million ounces, comes from primary silver mines, where silver is the main product. That is the only portion of supply that can even theoretically respond to price signals, and even then, it responds slowly. Now, look at the demand side. According to industry data, industrial silver demand reached record levels in 2024, rising sharply from the prior year. Solar photovoltaic manufacturing consumed approximately 200 million ounces. Electric vehicles and charging infrastructure consumed roughly 55 million ounces. Electronics and semiconductors used about 90 million ounces. Fifth-generation telecom infrastructure, data centers, and AI hardware consumed an estimated 45 million ounces. When you add investment demand, jewelry, silverware, and other uses, total global silver demand in 2024 reached approximately 1.05 billion ounces. Supply was 780 million ounces. Demand exceeded supply by roughly 270 million ounces. That deficit did not disappear. It was filled by drawing down above-ground stockpiles. Metal came out of vaults. It came from recycling. It came from investors liquidating ETFs and physical holdings. But above-ground inventories are not infinite. Data from Western vaults shows that registered silver inventories have collapsed over the past 5 years. COMEX registered silver, meaning metal that is actually warranted and available for immediate delivery, has fallen dramatically from hundreds of millions of ounces earlier in the decade to a fraction of that today. Total warehouse stock numbers are misleading because most of that metal is not registered and not available for delivery. The key point is this: the vaults are being drained, not replenished. And now Tesla has just removed 85 million ounces from the available supply. That single procurement is larger than the entire registered silver inventory of the COMEX. Think about what that implies. If one company can absorb more silver than exists in the deliverable futures market, what happens when 5 companies attempt the same strategy? What happens when Samsung, after losing this round, decides they need to secure 100 million ounces to protect future production? What happens when Apple sees Tesla and Samsung scrambling and concludes that it must stockpile silver for its own batteries, devices, and infrastructure? This is the doom loop. Scarcity creates hoarding. Hoarding creates more scarcity. Prices rise, which attracts even more hoarding. And eventually, the paper market collapses under delivery demands that cannot be met. Futures contracts, unallocated accounts, ETFs, all of it depends on the assumption that only a small fraction of holders will ever demand physical delivery. When that assumption breaks, the system breaks with it. Nowhere is this more visible than in Samsung's solid-state battery crisis. Samsung announced its solid-state battery breakthrough in early 2024. The media response was euphoric. A battery that charges in 9 minutes. A battery with a 600-mile range. A battery that lasts decades. This was positioned as Samsung's defining technological moment, the product that would vault it past Tesla, BYD, and every other competitor. Samsung signed memorandums of understanding with multiple automakers, including Stellantis, Hyundai, and a major German luxury brand. The contracts were expected to generate roughly $18 billion in revenue over 5 years. But those contracts included a critical clause, guaranteed delivery timelines. If Samsung cannot deliver the batteries on schedule, the automakers are free to cancel and source from alternative suppliers. Right now, Samsung cannot deliver. They attempted to secure 20 million ounces of silver for the first quarter of 2026. They obtained 8 million. That is a 60% shortfall. With 8 million ounces, Samsung can produce roughly 250,000 battery packs. That is enough for pilot programs and testing. It is not enough for mass production. It is not enough to fulfill contractual obligations. After the procurement failure, Samsung's executive committee convened a second emergency meeting on January 14th, 2026. The meeting reportedly lasted more than 4 hours. According to sources familiar with the discussion, the tone was grave. The chief supply chain officer presented 3 options. The first option was to delay the solid-state battery launch by 12 to 18 months and wait for silver supply conditions to improve. This preserves the technology but risks losing contracts and market relevance. The second option was to redesign the battery to reduce silver content. This preserves the launch timeline but sacrifices performance. Internal estimates suggest that cutting silver usage by half would reduce range from 600 miles to roughly 420 miles and increase charge times from 9 minutes to more than 16. That eliminates the core competitive advantage. The third option was to acquire a silver mining company. Samsung would vertically integrate supply by purchasing a primary silver producer, securing captive production. This option would likely require a $3 to $5 billion acquisition and several years to ramp output, but it would guarantee long-term access to silver. The fact that a consumer electronics company is even considering buying a mining operation tells you everything about the severity of the situation. While Samsung debates its options, Tesla is sitting on 85 million ounces of silver. Tesla has removed its supply chain risk for 2026 and 2027. That alone gives it an enormous competitive advantage. If you are an automaker choosing between Samsung's unproven solid-state batteries, backed by an unstable supply chain, and Tesla's proven battery technology with secured material inputs, the choice is obvious. But Tesla's move is not just about competition. It is about survival. The silver shortage is not a one-year event. It is a multi-decade structural problem. Silver mines take 8 to 12 years to bring from discovery to production. That process includes exploration, feasibility studies, permitting, financing, construction, and commissioning. Even if a massive new silver deposit were discovered tomorrow and fast-tracked at every stage, meaningful production would not arrive until the mid-2030s. And that assumes such deposits exist. They largely do not. The high-grade, near-surface silver deposits have already been mined. Modern deposits are deeper, lower grade, and more expensive to extract. Average silver ore grades have collapsed over the past 2 decades, falling from roughly 15 ounces per ton in the mid-2000s to about 4 ounces per ton today. That means miners must process nearly 4 times as much rock to produce the same amount of silver. That requires more energy, more water, more equipment, and more labor. All of those inputs are becoming more expensive. At current prices near $90 per ounce, many primary silver mines are operating near break-even. Any increase in energy costs or further grade declines pushes them into losses. The only way to incentivize new supply is significantly higher prices. Industry analysts estimate that silver must trade consistently above $150 per ounce to justify large-scale investment in new primary silver mines. Even then, new supply would not arrive until the 2030s. For the next 5 to 7 years, supply is effectively fixed. There is no surge capacity. There is no strategic reserve. Governments sold their silver stockpiles decades ago. The United States, once holder of billions of ounces, liquidated its remaining inventory in the early 2000s. Meanwhile, demand is accelerating. The solar industry alone is projected to consume more than 230 million ounces of silver in 2026. Global electric vehicle production is expected to reach 17 million units, each requiring 30 to 50 grams of silver. If solid-state batteries gain adoption, that requirement jumps to 1,000 grams per vehicle. Data centers driven by AI and cloud computing are expanding at an unprecedented pace. Global data center power capacity has increased more than 50-fold since the year 2000. Every server, every switch, every power distribution unit contains silver. This demand is structural. It is non-discretionary. You cannot build modern infrastructure without silver. And the companies that control the silver control the future. This is why $120 per ounce is not the top. It is the waypoint. Yesterday, January 14th, 2026, silver closed at $92.25 per ounce. That is a record nominal high. But here's the truth that almost nobody understands yet. At $92, silver is still cheap. Not emotionally cheap, mathematically cheap. And I'm going to prove that to you step by step. Let us start with a simple assumption. Samsung has already lost the first battle, but they cannot afford to lose the war. To salvage their solid-state battery program, Samsung will need to secure massive quantities of silver going forward. Let us conservatively assume they decide they must acquire 100 million ounces over the next 2 years to protect their production timeline and avoid another supply shock. Now add Tesla's move into the equation. Tesla has already secured 85 million ounces. Once that purchase becomes widely known, it will not be viewed as an anomaly. It will be interpreted as a warning. Apple, Google, BYD, LG, Panasonic, and every major technology and automotive manufacturer will draw the same conclusion. If they do not build strategic silver stockpiles now, they risk being shut out later. Let us be conservative again. Assume that collectively, these companies attempt to acquire 300 million ounces of silver over the next 12 months. Now ask the most important question. Where does that silver come from? It does not come from the mines. Mine production is already allocated under long-term contracts. It does not come from recycling. Silver recycling produces roughly 180 million ounces per year, and that supply is already baked into the existing balance. There is no hidden surge of scrap silver waiting to come online. That silver can only come from existing holders. It comes from investors who bought silver at $28 or $30 and are tempted to sell at higher prices. It comes from ETFs liquidating metal to meet redemptions. It comes from weak hands who panic during volatility. But here is the key dynamic that breaks the system. To bring 300 million ounces out of strong hands and into the market, the price must rise high enough to overcome their reluctance to sell. If you are holding physical silver, and you know that Tesla just paid between $140 and $160 per ounce for guaranteed delivery, why would you sell your metal for $90? You would not. You would wait. You would demand $120, $150, $200 or more. And the buyers, the Teslas and the Samsungs of the world are not price sensitive. They are supply sensitive. They will pay whatever price is necessary, because the alternative is not having the metal and not being able to manufacture products worth tens or hundreds of billions of dollars. This is how markets clear when supply is inelastic and demand is non-discretionary. Prices do not rise gradually. They go vertical. We have seen this movie before. When investors realize that industrial users are panic buying, when they see Tesla securing 85 million ounces and paying triple-digit prices for physical delivery, investment demand will surge. Retail investors will buy. Institutions will buy. Sovereign wealth funds will buy. That adds another 200 to 300 million ounces of annual demand on top of an already impossible industrial balance. At that point, the supply-demand imbalance becomes catastrophic. The futures exchanges cannot deliver. The ETFs cannot meet redemptions. Unallocated accounts are exposed for what they are. Paper promises backed by fractional metal. The paper market breaks, and a reset follows. Now let me walk you through the next 6 months, month by month, so you can see exactly how this unfolds. In February 2026, the COMEX March silver contract reaches first notice day. As of mid-January, there are roughly 45,000 contracts open in that delivery month. Each contract represents 5,000 ounces. That is 225 million ounces of potential delivery demand. The COMEX registered inventory, the metal actually available for delivery, is approximately 82 million ounces. If just 20% of contract holders stand for delivery, that is 45 million ounces demanded from a vault system that does not have excess capacity. The exchange will respond the only way it can. Margin requirements will be raised to force liquidation. Position limits will be tightened. Cash settlement incentives will quietly appear. These measures do not solve the problem, they only delay it. And when the market sees the exchange scrambling, confidence erodes. The price spikes. By the end of February, silver trades between $105 and $112 per ounce. In March 2026, Samsung officially announces a delay in its solid-state battery launch. The language will be carefully sanitized. They will cite supply chain optimization, additional testing, or phased rollout strategies. But the market will understand the truth. Samsung does not have the silver. Automaker contracts are renegotiated. Some are quietly canceled. Samsung's stock suffers. But the more important impact is psychological. If Samsung, with its scale, capital, and political influence, cannot secure silver, what does that mean for everyone else? Panic spreads through the EV and electronics industries. Procurement teams scramble. Bidding wars intensify. By the end of March, silver trades between $118 and $128 per ounce. In April 2026, Tesla reports record first quarter earnings driven by energy storage deployments. During the earnings call, Elon Musk is asked about raw material costs. He does not mention the silver purchase directly, but he makes a critical statement. Tesla has secured strategic materials for the next 24 months and is not supply constrained. The market understands exactly what that means. Analysts begin modeling the implications. If Tesla requires roughly 18 million ounces per year and has secured 85 million ounces, Tesla has more than a 4-year buffer. That allows Tesla to outcompete rivals who are facing shortages, delays, and rising costs. Tesla's competitive moat widens overnight. Tesla stock rallies, but the bigger story is what happens in the silver market. Mainstream investors finally understand that silver is not just a commodity, it is a strategic industrial asset. Investment demand surges. By the end of April, silver trades between $135 and $148 per ounce. In May 2026, the paper market finally cracks. A major silver ETF announces a temporary suspension of physical redemptions due to extraordinary market conditions. Shares can still trade, but investors can no longer exchange them for bars. The arbitrage mechanism breaks. Physical silver decouples from paper silver. Premiums explode. $50, $70, even $100 over spot becomes common for immediate delivery. Dealers sell out. Delivery times stretch to 16, 20, even 30 weeks. Panic buying sets in. By the end of May, silver trades between $158 and $172 per ounce. In June 2026, China escalates the situation. Silver is officially designated as a strategic resource. Export quotas are reduced again. Domestic manufacturers are prioritized. BYD, CATL, and Chinese solar producers get first access. Western companies are cut off almost entirely. This is the same playbook China used with rare earth elements, and it works. Shanghai prices decouple from Western markets. Silver trades near $200 per ounce in Asia, while COMEX lags far behind. Arbitrage cannot close the gap because there is no metal to move. By the end of June, silver trades between $175 and $195 per ounce. And that is just the first 6 months. Beyond mid-2026, the situation becomes even more extreme. Industrial buyers who fail to secure supply early face a brutal choice. They either halt production or they pay whatever price is necessary to keep their factories running. And they will pay. They will pay $200. They will pay $300. Because even at those prices, silver remains a tiny fraction of the cost of finished goods. An electric vehicle selling for $50,000 contains less than $300 worth of silver, even at triple-digit prices. Manufacturers cannot redesign silver out of products fast enough, and they cannot afford to stop production. This brings us back to the central thesis. Tesla's 85 million ounce purchase was not market manipulation. It was a chess move. It was Elon Musk looking years ahead and recognizing that control of critical materials determines control of industries. Tesla insulated itself from a supply chain that is breaking. In doing so, it accelerated the break. Now, every CEO, every CFO, every supply chain director at every major tech and automotive company is asking the same question. Do we need to do what Tesla just did? The answer is yes, but the silver is gone. Tesla took it. That is why Samsung is in crisis. That is why the solid-state battery launch is in jeopardy. That is why $120 is not a forecast. It is the next waypoint. If you are holding physical silver, you are holding the same asset that the most powerful companies on earth are panic buying at premiums of $50 to $70 over spot. You are holding metal that Tesla was willing to pay $140 to $160 per ounce to secure. Why would you sell at $90? You would not. This is not a trade. This is a supply squeeze. And supply squeezes do not resolve gently. They resolve violently when prices rise high enough to force demand destruction, redesigns, and shutdowns. Based on history, based on math, and based on the reality that silver represents less than 1% of the cost of most finished products, the clearing price is likely north of $250 per ounce. The window is now. The battle for silver has begun. Tesla won the first round. Samsung lost. And $120 is not the destination. It is just the beginning of the silver battery war.